Do you dream of financial freedom but find yourself waking up every day just to manage chaos? You started your business to own your time, but right now, it feels like the business owns you. Here is the hard truth. Most small business owners aren't building wealth. They've simply bought themselves a high-stress job. Revenue is vanity, profit is sanity, but cash flow is king. If you're looking for a get-rich-quick scheme, click away now. But if you're ready to stop trading time for money and start building an asset that pays you while you sleep, you are in the right place. Today, we are stripping away the guru fluff. We are going to look at the practical, mathematical realities of how you take a small operation, whether you're a freelancer, a bakery owner, or running an e-commerce store, and turn it into a vehicle for genuine, long-term wealth. We're breaking this down into 3 critical phases: mastering your financial foundation, scaling operations effectively, and diversifying your income streams. By the end of this video, you will have a realistic blueprint to move from just a business owner to a true wealth builder. Let's dive in. If you want to build wealth, you have to stop acting like a business owner and start acting like a chief financial officer. The single biggest reason small businesses fail to generate personal wealth for their founders isn't a lack of sales, it is a lack of financial discipline. You cannot scale a mess. If your current financial habits are chaotic, adding more money will only magnify that chaos. So before we talk about expansion, we have to build the fortress. The first step in this phase is what I call the Great Wall. This is the absolute non-negotiable separation of your business finances and your personal finances. It sounds basic, yet over 60% of small business owners blur these lines. If you're paying for your groceries out of your business checking account or putting business software subscriptions on your personal credit card, you are sabotaging your wealth in 2 ways. First, you are piercing the corporate veil, which destroys your legal liability protection. Second, and more importantly for wealth building, you are blinding yourself to the true health of your company. You cannot optimize what you cannot measure. To fix this immediately, you need a rigid account structure. You need a primary operating account for income, a separate account for taxes, a separate account for profit, and distinct accounts for operational expenses. When revenue hits your main account, it shouldn't stay there. It needs to be allocated instantly. This brings us to the concept of paying yourself first. Most entrepreneurs run their business on the formula, sales expenses equals profit. The problem with this formula is that it puts you last. You spend money on rent, vendors, software, and coffee, and then you hope there are leftovers for you. Usually there aren't. To build wealth, you must flip the equation to sales profit equals expenses. Every single time a deposit hits your bank, take a predetermined percentage, start small, maybe 5% or 10%, and move it to a wealth hold account. This money is not for business reinvestment, it is for you the owner, it is your reward for risk. By removing the profit first, you force your business to run on the remaining cash. This creates artificial scarcity, which is a powerful psychological tool. When you see less money in your operating account, you become more innovative, you negotiate harder with vendors, and you cut unnecessary fat. This is how you bake profitability into the DNA of your company rather than treating it as an afterthought. Now let's talk about the silent killer of small business wealth, cash flow gaps. You can be profitable on paper and still go bankrupt. This happens when your accounts receivable, the money people owe you, is high but your actual bank balance is low. Wealth is built on liquidity. If you're waiting 60 or 90 days to get paid by clients, you are effectively acting as a bank for them, offering them an interest-free loan while you starve. To fix this, you must tighten your payment terms. This is a practical wealth strategy. Move clients to retainers or upfront payments. Offer small discount like 2% or 5% for immediate payment. Every day that cash sits in your client's bank account instead of yours, it is losing value for you. You need that capital immediately to reinvest or to move into your wealth-building buckets. Cash flow velocity, the speed at which money moves through your business, is more important than the total amount of revenue. A business doing $200,000 a year with instant cash flow is often better for wealth building than a business doing $500,000 a year that waits 6 months to get paid. Once you have controlled the flow of money, you must ruthlessly audit your expenses. I'm not talking about being cheap, I'm talking about being efficient. Expenses in a small business tend to creep. It's the subscription creep, the $50 here, the $100 there for tools you haven't used in 6 months. Conduct a quarterly financial exorcism. Print out your last 3 months of bank statements and highlight every single outgoing expense. If an expense does not directly contribute to acquiring a customer or fulfilling a promise to a customer, cut it. Every dollar you save in expenses is worth more than a dollar in new revenue, because a saved dollar is pure profit, whereas a revenue dollar comes with the cost of goods sold and labor attached to it. The next layer of financial mastery is understanding your unit economics. This is where the wealthy separate themselves from the struggling. Do you know exactly how much it costs you to deliver 1 unit of your product or 1 hour of your service? This includes not just the materials but the allocated labor, the marketing cost to acquire that specific customer CAC, and the overhead. Many business owners scale their way into poverty because they are selling a product at a loss and don't realize it. They think, if I just sell more, I'll make money. But if you lose $5 on every unit, selling 1,000,000 units just means you lose $5 million. You need to calculate your gross profit margin on every single offering. If your margin is thin, say under 20% or 30%, you have a very difficult path to wealth. You either need to raise prices or lower costs. Raising prices is terrifying for small business owners, but it is necessary for wealth. When you raise prices, you may lose the bottom 20% of your customers, the ones who complain the most and pay the least. That is actually a good thing. It frees up your time to serve the top 20% who value quality and are willing to pay for it. Higher margins allow you to accumulate cash reserves. Those reserves are your opportunity fund. Wealth isn't built in the good times. It's built by having cash ready when the market crashes or when a competitor stumbles and you can buy their assets for pennies on the dollar. Finally, in this financial foundation phase, we must address the bridge between the business and the individual, the tax strategy. The tax code is a rulebook for wealth, not just a bill. The average small business owner overpays taxes by thousands every year simply due to a lack of planning. You need to move beyond a tax preparer who just files your forms in April and hire a tax strategist who meets with you quarterly. You should be looking at strategies like the Augusta Rule, which allows you to rent your home to your business for board meetings tax-free for up to 14 days a year. You should be looking at maximizing contributions to a SEP IRA or a solo 401k, which allows you to shelter massive amounts of income from taxes and let it grow for your future. Buying a vehicle under the business name if it weighs over 6,000 pounds for the Section 179 deduction is another common lever. These aren't loopholes, they are incentives written by the government to encourage business investment. If you aren't using them, you are voluntarily donating your potential wealth to the IRS. To summarize this first phase, your business is a machine. If the machine leaks oil, cash, and overheats expenses, it cannot take you to your destination. You must separate your accounts, prioritize profit over revenue, shorten your cash flow cycles, audit your expenses ruthlessly, optimize your pricing for high margins, and use the tax code to keep what you earn. Only once this financial engine is tuned and efficient can we look at pouring fuel on the fire, which leads us to the next critical step: scaling your operations without breaking them. Welcome back. In part 1, we secured the perimeter by locking down your finances. Now we are going to talk about growth, but I want to be very clear. Growth is not just getting bigger. Growth is often the thing that kills a small business. If you grow a chaotic business, you just end up with a bigger disaster. We are talking about scale. There is a fundamental difference between growth and scale. Growth means adding resources at the same rate that you add revenue. You get a new client, so you hire a new employee. You make $10 more, but you spend $9 to get it. That is a treadmill, not a wealth builder. Scale is when your revenue increases exponentially while your costs increase only incrementally. Scale is where wealth lives. To get there, you have to stop being the chief everything officer. Subsection 1: The bus factor and the power of systems. Let's start with a brutal question. If you got hit by a bus tomorrow, or less morbidly, if you decided to take a month-long vacation to Bali without checking your email, would your business survive? If the answer is no, you don't own a business, you own a job. And you cannot scale a job because there are only 24 hours in a day. To build wealth, you must render yourself useless. Yes, your goal is to be the least important person in the daily operations of your company. You do this by building systems and standard operating procedures, SOPs. Most small business owners keep their processes in their heads. They just know how to handle that difficult client or how to fix that specific glitch. This is a trap. You need to extract that knowledge from your brain and put it into a playbook. Every repeatable task in your business needs an SOP. This isn't just bureaucratic paperwork, it is an asset. Start with the 3-time rule. If you have to do a task more than 3 times, record it. Use a tool like Loom to record your screen while you do it, or use voice-to-text to talk through the steps. Create a checklist. How do you onboard a client? How do you handle a refund? How do you post to social media? When you document your processes, you create a standard of excellence that doesn't rely on your mood or energy level. This allows you to hand off tasks to lower-cost labor without sacrificing quality. This is the essence of leverage. You cannot focus on $1,000 per hour strategy work if you're stuck doing $15 per hour admin work. SOPs are the ladder you use to climb out of the weeds. Subsection 2: The WHO hearing for ROI, not just relief. Once you have systems, you need people to run them, but most small business owners hire wrong. They hire out of desperation. They are drowning in work, so they grab the first person who seems capable of fogging a mirror just to get some relief. This is panic hiring, and it destroys wealth. To build a wealthy business, you must view employees not as overhead or expenses, but as investments that must yield a return. This is a mindset shift. When you hire someone, you should have a clear mathematical path to how that person will make the company 3 times their salary. If you hire a salesperson for $50,000, they need to bring in $150,000. If you hire an admin assistant for $30,000, they need to save you enough hours so that you can go out and generate $90,000 of new business in that freed up time. If you cannot draw that line to ROI, do not make the hire. You also need to understand the concept of the who, not the how. As entrepreneurs, we are obsessed with how do I do this? How do I fix the website? How do I run the ads? The wealthy entrepreneur asks, who can do this better than me? You want to hire A players. An A player is not just someone who is good at their job, it is someone who doesn't need to be managed. Managing people is expensive, it costs you time and emotional energy. An A player takes the outcome you want and figures out the path to get there. They are expensive up front, but they are infinitely cheaper in the long run because they drive growth without dragging you down. Be slow to hire and quick to fire. That sounds harsh, but keeping a mediocre employee on the payroll because you feel bad for them is a form of charity, not business. A toxic or incompetent employee doesn't just cost their salary, they cost you opportunity, they damage your culture, and they scare away your A players. Protect your team culture fiercely. Subsection 3. Automation, the robot employee. Before you hire a human, hire a robot. Humans are wonderful, but they get sick, they get tired, they need motivation, and they make mistakes. Software does none of those things. In the age of AI and no-code tools, you can automate a massive chunk of your business for pennies on the dollar. Look at your customer journey map. Where are the friction points? When a lead fills out a form on your site, does someone have to manually copy-paste that into a spreadsheet? Automate it with Zapier to go straight to your CRM. Are you manually sending invoices and chasing late payments? Automate it with QuickBooks or Xero reminders. Are you scheduling meetings by emailing back and forth? Does Tuesday work? No, how about Wednesday? Automate it with Calendly. These seem like small things, but they add up to hundreds of hours a year. Automation buys you time, and time is the raw material of wealth. Furthermore, automation provides data consistency. You cannot scale if your data is messy. You need a dashboard. You need to be able to look at one screen and see your leads, conversion rate, churn rate, and net profit. If you're flying blind, you will crash when you try to speed up. Subsection 4. Marketing leverage, determining your CAC and LTV. Finally, to scale, you need a predictable engine for acquiring customers. You cannot rely on word of mouth if you want to build serious wealth. Word of mouth is great, but it is unscalable and unpredictable. You cannot turn a dial and get more word of mouth. You need a marketing funnel where you know the math. This comes down to 2 numbers, CAC, customer acquisition cost, and LTV, lifetime value. How much does it cost you to buy a customer? If you spend $100 on Facebook ads to get one person to buy, your CAC is $100. How much is that customer worth to you over the next 3 years? If they buy once for $50, you are going out of business. If they buy a monthly subscription of $50 for 2 years, their LTV is $1,200. If you can spend $100 to make $1,200, you have a wealth machine. You can scale that to the moon. You should be spending as much as possible on that ad because it's a money printer. But if you don't know these numbers, you are gambling. Scaling is about removing the gamble. It is about testing, iterating, and finding a channel, whether it's cold email, LinkedIn content, paid ads, or partnerships, that yields a predictable return. Once you have this, you focus on retention. It is 5 to 10 times cheaper to sell to an existing customer than to find a new one. Wealth is built on the back end. The first sale often just covers the acquisition cost. The profit, the wealth money, comes from the second, third, and fourth sale. Implement email marketing, loyalty programs, and upsells. Maximize the value of every single person who enters your ecosystem. Summary of Part 2. Scaling is not an accident. It is an engineering problem. You build the systems so the business runs without you. You hire A players to drive the systems. You use automation to handle the grunt work. And you master the math of marketing to turn $1 of advertising into $5 of profit. Now that we have a business that runs like a well-oiled machine and generates excess cash, what do we do with that cash? We don't just leave it in the business. We move to the final phase, diversification and empire building. We have stabilized the cash flow, we have scaled the operations. Now we reach the phase where true wealth is solidified, diversification. There is a dangerous myth in entrepreneurship that you should reinvest everything back into the business. In the early days, yes, that is true, you need to feed the baby. But once the business is mature and profitable, reinvesting everything is actually a risk. If 100% of your net worth is tied up in your small business, you are one regulation change, one platform algorithm update, or one lawsuit away from zero. Wealth is not about how much money you make, it is about how much money you keep and how hard that money works for you. This phase is about taking chips off the table. Subsection 1. Internal diversification, the ecosystem model. Before we look outside the business, let's look inside. Can you diversify your income streams without leaving your brand? This is about increasing the share of wallet of your existing customers. You already did the hard work of acquiring them, now solve more of their problems. If you sell a service, can you sell a product? If you are a consultant, can you sell a digital course? Digital products are the holy grail of margin. They cost almost nothing to replicate. If you run a landscaping business, can you sell a line of branded fertilizers or a seasonal maintenance guide? Look for recurring revenue models. Wealth loves predictability. If you're constantly hunting for new sales every month, you are on a hamster wheel. You want subscriptions. Can you turn your product into a service? Can you offer a VIP membership? When you have recurring revenue, your business valuation, the amount someone would pay to buy your company, skyrockets. Investors pay a premium for predictability. Subsection 2. External diversification, the freedom fund. Now let's talk about the money you pulled out of the business. That wealth hold account we talked about in part 1. You need to move this capital into assets that have zero correlation to your business performance. This is your freedom fund. The goal here is boring, unsexy consistency. If your business is the high-risk, high-reward engine, the Ferrari, your personal investments should be the tank. Real estate, this is a favorite for business owners because of the synergy. If your business needs a physical location, a warehouse, an office, a storefront, buy the building, don't rent. When your business pays rent to you, the landlord, you are moving money from your left pocket to your right pocket, but now you are building equity in an appreciating asset. Plus, the tax benefits of depreciation are massive. The market, low-cost index funds. It sounds cliché, but it works. You are already taking massive risks in your business. You don't need to gamble on individual stocks. You want the market average compounding at 7% to 10% over decades. This is your safety net. Other businesses, once you master the skill of business, marketing, sales, operations, you can apply it anywhere. You can start buying other small businesses. This is called acquisition entrepreneurship. Maybe you buy a competitor who is struggling, merge them into your operations, and instantly double your client base. The rule is simple. The business makes you rich. The investments make you wealthy. The business provides the cash flow. The assets provide the freedom. Subsection 3. The exit strategy, building to sell. Finally, we have to talk about the end game. Even if you never plan to sell your business, you must build it as if you are going to sell it tomorrow. Why? Because a business that is sellable is a business that is enjoyable to own. A sellable business creates profit without the owner's daily intervention. A sellable business has clean books, clear SOPs, and a diversified customer base. There are 3 main ways to exit. The cash cow, you keep the business, hire a CEO to run it, and you just take the quarterly profit distributions. This gives you cash flow for life. The strategic sale, you sell to a competitor or a private equity firm. This is usually a multiple of EBITDA earnings before interest, taxes, depreciation, and amortization. If your business makes $1 million in profit and the market multiple is 4x, you walk away with a $4 million check. That is life-changing money. The legacy, you pass it down to family. This is tricky and requires immense planning to ensure the next generation is actually capable of running it. To prepare for an exit, you need at least 2 years of pristine tax returns. You need to show growth trends, and most importantly, you need to prove that the business is not the you show. If the customers only want to talk to you, the business is worthless without you. Conclusion: the long game. Building significant wealth takes time and consistent effort. We have covered a lot of ground today. We started by fixing your financial foundation and separating your personal identity from your business money. We talked about the mechanics of scaling, using systems, automation, and data to grow without exploding. And finally, we discussed diversifying that cash into an empire that secures your future. By implementing these practical strategies and maintaining a focused mindset, you can set your small business on the path to long-term financial success. You are no longer just a freelancer or a shop owner. You are a capital allocator. You are an investor. This journey is not a straight line. There will be months where cash flow is tight. There will be hires that don't work out. That is the price of admission, but remember why you started. You didn't start this business to be a slave to it. You started it to build a life of freedom. The best time to plant a tree was 20 years ago. The best time to start treating your business like a wealth vehicle is right now. Don't just watch this video and go back to the daily grind. Pick one thing we discussed, maybe opening that separate tax account or writing that first SOP. Building significant wealth takes time and consistent effort. It is not an overnight event. It is a series of disciplined choices made over years. We have covered the roadmap today, from securing your financial fortress to scaling your operations and finally diversifying into an empire. These aren't secrets, they are systems. By implementing these practical strategies and maintaining a focused mindset, you can set your small business on the path to long-term financial success. You have the blueprint now. The only variable left is your execution. Don't let this be just another video you watch and forget. Pick one strategy we discussed today, whether it's auditing your expenses or documenting your first SOP, and implement it before the sun goes down. Start today and unlock your potential. If you found value in this deep dive, hit that like button so this message reaches more entrepreneurs like you. And if you are serious about mastering the game of money and business, make sure to subscribe and turn on notifications. I'll see you in the next video.